For millions of Americans, the economy doesn't collapse all at once. It collapses quietly. In the middle of the night. With a tow truck. Car repossessions are rising again. And unlike previous cycles, this one feels different. Because this time, the pressure isn't just unemployment. It's interest rates. It's inflation. It's stretched household budgets. And it's the quiet exhaustion of consumers who are already carrying too much debt. During the pandemic, stimulus checks, low interest rates, and payment pauses created breathing room. Auto loans became cheaper. Dealership demand exploded. Car prices surged. Consumers financed aggressively. But cheap money doesn't last forever. Rates rose. Used car values peaked and began falling. Loan payments increased. And for many households, income didn't keep pace. Now we are seeing the consequences. Repossession activity is climbing. Subprime delinquency rates are rising. Auto loan balances remain elevated. And many borrowers owe more than their cars are worth. This isn't just about cars. It's about fragility. Because when households start losing essential assets, financial stress becomes visible. And visible stress spreads faster than invisible debt. To understand what's happening, we need to examine how auto loans became so stretched in the first place. The easy money auto boom. The car market changed dramatically over the past few years. When interest rates were near zero, borrowing became cheap. Consumers could finance vehicles at historically low rates. Dealership inventories were constrained due to supply chain disruptions. Low supply met high stimulus-driven demand. Prices surged. New car prices rose sharply. Used car prices followed. Some used vehicles were selling for more than their original purchase price. This created a psychological shift. Cars stopped feeling like depreciating assets. They felt scarce, valuable, urgent to secure. Consumers stretched to buy. Longer loan terms became common. 6-year loans, 7-year loans, even 8-year financing options. Monthly payments were kept manageable by extending duration. But extending duration increases total interest paid. It also increases risk exposure. If income declines or expenses rise, long-term commitments become fragile. At the same time, lenders expanded access. Subprime auto lending grew. Credit standards loosened during peak demand. Risk was distributed through securitized auto loan bundles. Investors searching for yield absorbed those bundles. Auto debt became embedded in broader financial markets. Meanwhile, inflation began rising. Gas prices increased. Food costs climbed. Housing became more expensive. Even households with stable income felt pressure. When interest rates began rising aggressively, new auto loans became more expensive. Variable rate borrowers faced higher payments. Refinancing became harder. The structure that supported the auto boom began tightening. Now consider depreciation. As supply chains normalized, used car values began declining. Borrowers who purchased at peak prices found themselves underwater, owing more than their vehicle's current value. When negative equity meets rising interest rates and higher living costs, default probability increases. Repossession is rarely a first choice. It is a last-stage outcome. It means payments were missed. Options were exhausted. Savings were depleted. This is what makes auto repossession data important. It is not about vehicles. It is about household resilience. Cars are not luxury assets. They are economic lifelines. For commuting. For income. For daily function. When households lose cars, job stability can deteriorate. When job stability deteriorates, delinquency spread. This is how micro-stress becomes macro-risk. The auto loan market may not be as large as housing, but it is deeply connected to working households. And when stress rises in working households, broader consumption patterns shift. In the next chapter, we examine delinquency trends and lender behavior. Because rising repossessions are not random. They reflect structural strain building beneath the surface. Rising delinquencies and lender exposure. Repossession is the final stage. Before a car is taken back, payments are missed. Before payments are missed, budgets are strained. Delinquency data tells the story earlier than tow trucks do. Across income levels, late payments on auto loans have been increasing. The rise is most visible in subprime borrowers. But stress is no longer confined to subprime. Prime borrowers are also showing signs of pressure. Why? Because the issue is not just credit quality. It is affordability. Auto loans today are larger than they were a decade ago. Vehicle prices rose sharply during the supply shock. Higher prices mean higher principal balances. Higher principal balances mean higher monthly payments. Even with longer loan terms, monthly obligations climbed. At the same time, interest rates moved up. New borrowers face significantly higher financing costs. Existing borrowers who refinanced during the boom are locked into long-term commitments. If inflation continues eroding disposable income, the margin for error shrinks. Now consider the lender side. Auto loans are often bundled into asset-backed securities. These securities are sold to investors seeking yield. When delinquency rates rise, the performance of those securities becomes critical. If defaults increase gradually, markets adjust. If defaults accelerate, risk premiums widen. Lenders respond by tightening credit standards. Tighter standards reduce loan availability. Reduced loan availability lowers vehicle demand. Lower demand pressures dealerships. Dealership pressure affects manufacturers. Manufacturers reduce production. Production cuts influence employment. The chain reaction is slow. But it is real. Another key factor is negative equity. Many borrowers financed vehicles at peak prices. As used car values decline, negative equity expands. When someone owes more than their car is worth, selling is not an easy escape. If income falls or expenses rise, the borrower is trapped. This increases default risk. There is also behavioral strain. During stimulus years, households built temporary savings buffers. Those buffers have largely diminished. Credit card balances have increased. Interest on revolving debt is high. Auto payments compete with housing, food, and utilities. When households must choose, non-essential payments are cut first. But cars are essential. Which means when auto payments are missed, financial stress is severe. Repossession data therefore acts as an economic early warning signal. It indicates that liquidity at the household level is tightening. And when household liquidity tightens, consumption slows. Consumption drives a large portion of economic activity. Now consider psychological spillover. Visible repossessions alter perception. If communities see increasing vehicle recovery activity, confidence declines. Confidence influences spending. Reduced spending affects corporate earnings. Corporate earnings influence market valuations. The transmission mechanism is subtle but interconnected. This is not 2008. Auto loans are smaller relative to mortgages. But the underlying theme is similar. Credit expansion during easy money periods creates fragility when conditions tighten. The auto boom was fueled by cheap capital. The unwind is shaped by higher rates and declining asset values. In the next chapter, we examine how this stress interacts with employment and income stability. Because repossession does not exist in isolation. It reflects broader financial pressure building across households. Employment pressure and the household feedback loop. A car is not just an asset. For many households, it is access. Access to work. Access to income. Access to stability. When repossessions rise, the impact goes beyond missed payments. It disrupts daily economic function. Many jobs, especially outside dense urban centers, require reliable transportation. Shift work, warehouse jobs, healthcare support roles, delivery and logistics, construction. Losing a vehicle can mean losing punctuality, losing reliability, losing employment altogether. This creates a feedback loop. A missed payment leads to repossession. Repossession makes it harder to get to work. Difficulty getting to work increases job risk. Job risk reduces income. Reduced income increases default probability on other debts. Auto repossession is often not the beginning of financial distress. It is the midpoint. Now consider income dynamics. Wage growth has not kept pace with the cost of living for many households. Even where wages have risen, inflation has absorbed much of the gain. Housing costs remain elevated. Food prices are higher. Energy expenses fluctuate. Insurance premiums have increased. These pressures compress discretionary income. When budgets are tight, even small disruptions matter. A few missed hours, a delayed paycheck, an unexpected repair. The margin for error disappears. Transportation loss magnifies that vulnerability. There is also a geographic dimension. In suburban and rural areas, public transportation is limited. A repossessed car can isolate a household. Isolation reduces job opportunities. It increases reliance on informal arrangements. Carpooling, ride sharing, temporary fixes. These solutions are unstable and expensive. Now consider employer behavior. When labor markets tighten, employers compete. When labor markets soften, flexibility disappears. Workers facing transportation issues may not receive accommodations. Attendance issues lead to reduced hours or termination. This increases labor churn. Labor churn reduces income stability. Income instability feeds back into credit performance. This is how micro-disruptions scale. Auto repossession may appear isolated, but it intersects with employment resilience. And employment resilience underpins consumption. When households reduce spending due to instability, demand weakens. Weak demand affects businesses. Businesses adjust hiring. Hiring adjustments feed back into labor pressure. The cycle continues. There is also psychological stress. Financial instability creates anxiety. Anxiety affects decision-making. Households may delay necessary expenses. Healthcare, education, maintenance. Deferred expenses often reappear later at higher cost. This compounds long-term fragility. From a macro perspective, rising repossessions signal that economic pressure is shifting from abstract indicators to lived experience. Interest rates, inflation, debt levels. These concepts become tangible when assets are taken. This visibility matters. Visible stress spreads faster than invisible leverage. Communities notice. Sentiment shifts. Economic narratives change. In the next chapter, we examine why this trend matters beyond autos. Because repossession is not the risk. It is the signal. And signals tell us where pressure is accumulating next. Why this matters beyond cars. Car repossessions are not a financial crisis. They are a stress indicator. On their own, auto loans are smaller than mortgages. They are unlikely to collapse the financial system. But that is not the point. The point is what they reveal. When households begin losing essential assets, it signals liquidity pressure. Liquidity pressure does not stay confined to one category. It spreads. Auto stress often precedes broader consumer strain. Because cars are typically prioritized. If a household falls behind on auto payments, it means other pressures are already present. Credit card balances may be rising. Savings buffers may be depleted. Buy now pay later balances may be expanding. Households juggle obligations until something breaks. Auto repossession is one of the visible breakpoints. Now zoom out. Consumer spending drives a significant portion of economic activity. When households feel fragile, spending slows. When spending slows, business revenue softens. When revenue softens, hiring slows. When hiring slows, income stability weakens. Weak income stability increases credit stress. The cycle becomes self-reinforcing. There is also the credit market layer. Auto loans are packaged into securities. If delinquency rates rise gradually, markets adjust calmly. If they accelerate unexpectedly, risk spreads widen. Wider spreads increase borrowing costs. Higher borrowing costs tighten financial conditions. Tighter financial conditions reduce growth. The signal here is not collapse. It is tightening. Auto repossession trends suggest that households are running out of flexibility. During the stimulus period, excess savings masked fragility. As those savings fade, underlying pressure becomes visible. This matters for policymakers. If household strain increases while interest rates remain elevated, policy trade-offs intensify. Lower rates risk inflation. Higher rates risk deeper household stress. This constraint environment is delicate. It also matters for investors. If consumer resilience weakens, sectors dependent on discretionary spending face headwinds. Retail, travel, restaurants, automotive sales, durable goods. A slowdown in these areas feeds back into earnings expectations. Earnings expectations influence market valuations. Market valuations influence wealth effects. And the loop continues. The auto repossession story is not dramatic. It is incremental. But incremental stress accumulates. Financial systems rarely break from a single event. They weaken through layers of pressure. Housing in 2008 was the trigger. Auto debt today is smaller. But it is part of a broader household leverage story. When multiple categories show strain simultaneously, risk compounds. Cars are being taken back. That does not mean collapse. But it does mean fragility is rising. And fragility matters. Because when the next shock arrives, the system's ability to absorb it depends on household resilience. If resilience is already thin, volatility spreads faster. This is why watching repossessions is important. Not because of the vehicles, but because of what they reveal about the economic foundation beneath them. Car repossessions are not the headline most people expect. They are not dramatic like stock crashes. They are not abstract like bond yields. They are quiet. They happen street by street, household by household. But quiet signals often matter most. Because they show us where pressure is building before it becomes visible in national statistics. When families begin losing essential assets, it tells us something important. Savings are thinner. Budgets are tighter. Debt burdens are heavier. Resilience is weaker. The auto market does not need to collapse to send a message. Rising repossessions simply tell us that households are running out of flexibility. And when flexibility disappears, the system becomes more sensitive to shocks. This is how financial cycles unfold. Not in one dramatic moment, but in layers. Easy money expands credit. Credit expands consumption. Consumption supports growth. Then conditions tighten. Growth slows. Debt becomes heavier. Assets begin to slip. One by one. Cars are not the economy, but they are a window into it. If transportation stress increases, employment stability can follow. If employment stability weakens, spending adjusts. If spending adjusts, growth moderates. And when growth moderates under high debt levels, policy options narrow. This is not a crisis declaration. It is a reminder. Economic strength depends on household stability. And household stability depends on manageable debt and sustainable income. When that balance weakens, signals appear. Right now, auto repossessions are one of those signals. In the next episode, we move from households back to institutions. Because financial pressure does not remain confined to consumers. Next, Samsung is in crisis. If you want to understand how household debt, corporate stress, and macro policy connect beneath the headlines, subscribe. Not for panic. For structural clarity.